The Treasury Department stopped publishing a specific number 3 weeks ago. Not the debt figure, not the deficit. Something else. Something that tells you who's actually willing to show up when the government needs to borrow money. And that silence is the only signal that matters right now. I'm going to walk you through the mechanics of what's happening inside the Treasury market in the next 60 days. Not speculation, not fear. Just the operational reality of how sovereign debt refinancing works when the assumption everything relies on stops being true. By the end of this, you'll understand why March 2026 isn't another debt ceiling drama. It's the month the math breaks. I monitor capital flows. I watch bid to cover ratios at Treasury auctions. I track the gap between what institutions say they all do and what they actually do when their risk limits get tested. What I'm seeing now is a liquidity structure that only works if everyone keeps pretending it works. Let me explain one term you need to understand: rollover risk. The US government doesn't just borrow new money to fund spending, it constantly refinances existing debt. Think of it like a credit card you pay off with another credit card every single month. That's not a problem as long as someone keeps approving the new card. The entire system depends on buyers showing up to every Treasury auction, every week, willing to lend to the US government at rates that keep the debt serviceable. Rollover risk is what happens when those buyers start asking for higher rates, or worse, when they stop showing up at all. Here's what you'll hear in March. The official story will be simple. Congress is debating the debt ceiling. The Treasury is using extraordinary measures. This is normal. We've been here before. The debt limit was reinstated at $36.1 trillion on January 2nd, 2025. By March, the Treasury will have exhausted its extraordinary measures, those accounting maneuvers that let the government keep borrowing without technically hitting the ceiling. Treasury Secretary Bessent will send letters to Congress. Congress will negotiate. Eventually, they'll raise the limit or suspend it, just like they always do. Markets will be volatile, but they'll stabilize. This is political theater. That's not what actually happened. What happened is the Treasury has been burning through $6.1 billion per day since January. The debt is now approaching $39 trillion. The Congressional Budget Office projected the X date, the day the Treasury runs out of cash and extraordinary measures, would arrive in August or September. But that projection assumed normal tax receipts and normal borrowing costs. Neither of those assumptions is holding. Here's how the system normally works. The Treasury announces an auction. Let's say they're selling $50 billion in 10-year notes. Primary dealers, the banks that are required to participate, submit bids. Institutional investors, foreign central banks, pension funds, insurance companies, they submit bids too. The auction clears, the Treasury gets its $50 billion, the dealers distribute the bonds, the secondary market trades them. The cycle repeats every week. This system has layers. Layer 1, the Treasury sets the auction schedule based on projected funding needs. Layer 2, primary dealers are obligated to bid, but they're not obligated to hold. They buy at auction and immediately sell to end buyers. Layer 3, those end buyers, pension funds, asset managers, foreign governments, they're the real demand, but they're price sensitive. If yields rise too fast, they wait. Layer 4. The Federal Reserve used to be the buyer of last resort through quantitative easing. They're not anymore. They're actively selling. Layer 5. Money market funds now hold $7.67 trillion in assets. Most of that is parked in short-term treasuries or reverse repos with the Fed. That's institutional cash sitting on the sidelines, waiting, earning 4%, taking zero duration risk. Every one of those layers depends on the layer below it functioning, and the entire structure depends on one core assumption: that the US government will always be able to borrow at rates low enough to service its debt without defaulting and without inflating the currency into irrelevance. That assumption can't hold anymore. Here's why. Net interest on the debt is now the second largest line item in the federal budget, larger than defense spending. The average maturity of US debt is just over 6 years. That means roughly 15% of the outstanding debt, about $5.5 trillion, needs to be refinanced every year. When the average rate on that debt was 2%, annual interest costs were manageable. Now the 10-year yield is trading above 4%. When the Treasury refinances maturing debt, it's paying double the rate it was paying 3 years ago. That's not a one-time jump. It's a permanent step function increase in the cost of carrying the debt. And it compounds. Every dollar of new borrowing and every dollar of refinanced old borrowing now carries that higher rate. The fiscal math becomes simple. If the government borrows another $1 trillion this year and the average rate is 4.5%, that's $45 billion in additional annual interest, forever, unless they pay down the principal, which they can't because they're still running a deficit, which means they need to borrow more, which means more interest. This is the debt trap. It's not a crisis of liquidity. It's a crisis of solvency. Let me walk you through the calculation that matters. Base assumption: the Treasury needs to refinance $5.5 trillion of maturing debt in 2026. New condition: The buyers of that debt now demand an average yield of 4.75%, 50 basis points higher than today, because they're pricing in either inflation risk, fiscal risk, or both. Catastrophic outcome. Annual interest expense increases by an additional $26 billion just from the refinancing, not from new borrowing. Now layer in the new borrowing. The deficit for fiscal 2026 is projected at $1.8 trillion. At 4.75%, that's another $85 billion in annual interest. Total increase, $111 billion in additional interest costs every year, permanently. This is where the math breaks. The Treasury can't cut spending by $111 billion overnight. Congress won't raise taxes by $111 billion. So the Treasury borrows more to pay the interest, which increases the debt, which increases the interest, which requires more borrowing. This is not a political problem, it's an arithmetic problem. And here's the mechanism that turns arithmetic into crisis: liquidity withdrawal. Right now, $7.6 trillion is sitting in money market funds. Those funds are earning 4% risk-free by lending overnight to the Federal Reserve or buying Treasury bills. They have no reason to move. But the Treasury needs long-term buyers. It needs institutions willing to lock in 10-year or 30-year notes. The problem is, those long-term buyers can see the same math. They know the fiscal trajectory is unsustainable, so they demand a premium. They want 5% on a 10-year, maybe 5.5%. The Treasury can't refuse. They need the money, so they pay it. But here's where it cascades. When the 10-year yield hits 5%, every pension fund, every insurance company, every asset manager with a duration target has to rebalance. They have to sell equities. They have to sell credit. They have to sell real estate because their liability matching models are breaking. Their actuarial assumptions assumed 3% yields. At 5%, the math of every retirement system in the country inverts. Public pensions are funded assuming 7% returns. If half their portfolio is in bonds yielding 5%, the other half needs to return 9% just to hit target. That's not happening. So they go to their state legislatures and say, we need more money. The legislatures say, we don't have it. The pensions say, then we're underfunded, and the death spiral begins. This is nonlinear failure. It doesn't move in a straight line. It moves in jumps. Think of a dam. The water level rises slowly, then it rises faster, then it breaches. Once it breaches, the collapse is instant. Or think of a crowded bar. Everyone's fine until someone yells fire. Then everyone runs for the exit at once. The exit is too small. People get trampled. The system wasn't designed for everyone to leave simultaneously. Financial markets are the same. They function because most participants assume they can exit before everyone else. When that assumption breaks, liquidity evaporates. Bid-ask spreads widen. Market depth disappears. Prices gap. And the feedback loop starts. Falling prices trigger margin calls. Margin calls force liquidations. Liquidations push prices lower. Lower prices trigger more margin calls. This is what happened in March 2020. It's what happened in September 2008. It's what happens every time a large interconnected market loses confidence in its own stability. Right now, we're watching two realities diverge. Reality one, the Treasury market is trading normally, auctions are clearing, yields are stable, the financial press says everything is fine. Reality two, the mechanics underneath are failing. The bid-to-cover ratios at recent auctions have been declining. That's the ratio of bids received to bonds actually sold. A declining ratio means fewer buyers relative to supply. Foreign central banks, which used to be the largest holders of U.S. Treasuries, have been net sellers for 2 years. They're diversifying. They're buying gold. They're buying euros. They're buying yuan. They're not buying treasuries. Domestic institutional buyers are still there, but they're shortening duration. They're buying bills, not bonds. Everyone wants short-term. No one wants long-term. Because no one believes the fiscal situation gets better in 10 years. So the Treasury has to keep offering higher yields to entice long-term buyers. But higher yields make the fiscal situation worse, which makes long-term buyers even more cautious, which requires even higher yields. This is the doom loop. Here's the split. On one side, the price. Treasury bonds are trading. Yields are quoted. The market is liquid. On the other side, the availability. Try to sell $100 billion of 30-year bonds in a single day. You can't. The market can't absorb that size without moving the price. Try to exit a large Treasury position in a crisis. You'll get a price, but it won't be the quoted price. It'll be the price that reflects the reality that there's no bid depth. The market is wide, not deep. It works for normal flow. It doesn't work for stress flow. The narrative says the U.S. Treasury market is the deepest, most liquid market in the world. The mechanics say depth is an illusion created by the assumption that everyone won't try to sell at once. When that assumption is tested, the illusion breaks, and we're about to test it. Because in March, the Treasury will hit the debt ceiling. Congress will debate. The Treasury will warn of catastrophic consequences. And every institutional investor will ask the same question. What if this time is different? What if they don't raise it in time? What if we have to price in default risk even for a day? And the moment that question gets asked, the exit gets crowded. There are 3 possible outcomes. Outcome 1, Congress raises the debt ceiling by $5 trillion in early March, well before the X date, with bipartisan support, no drama, no conditions. The Treasury continues borrowing. Markets stabilize. This is the fantasy scenario. Probability, 5%. It's not happening. The political dynamics don't allow for it. Both parties want concessions. Neither has an incentive to move first. Outcome 2, Congress fails to raise the ceiling. The Treasury runs out of cash. The U.S. government defaults on a bond payment, or it prioritizes some payments over others, which is functionally a default. Credit rating agencies downgrade U.S. debt. Treasury yields spike. Equity markets crash. The financial system seizes. The Federal Reserve has to intervene with emergency liquidity. This is the catastrophic scenario. Probability, 10%. It's possible, but unlikely, because the consequences are so severe that even the most reckless politician will flinch at the last moment. Outcome 3, Congress raises the ceiling in late March or early April, after extraordinary measures are exhausted, after the Treasury has warned repeatedly of imminent default, after markets have sold off 10 to 15%, after yields have spiked 50 to 75 basis points, after the political pressure becomes unbearable. They raise it, but not by $5 trillion, by $1 or $2 trillion, just enough to push the problem into late 2026 or early 2027, just enough to buy time. This is the managed crisis scenario. This is what actually happens. Probability, 85%. And it's the worst of the 3, because it doesn't solve anything. It just proves to every market participant that the U.S. government is ungovernable, that it will repeatedly weaponize the debt ceiling, that it will take the country to the brink again and again, and that fiscal discipline is never coming. Here's what this means for you. Do not panic. Panic is the enemy of rational decision-making. But do not ignore this. The savings account you have at a bank, earning 3%, is about to lose purchasing power. Not because the bank will fail, because inflation is coming back. The only way the U.S. government can sustainably manage its debt load without default is through inflation. They need to inflate the real value of the debt away. That means consumer prices rise. That means your cash loses value. Your savings account balance stays the same in nominal terms, but it buys less every month for years. The strategic mindset is this. Understand that we're in a regime change. The 40-year bull market in bonds is over. Yields are going higher, not lower. That means bond prices are going lower, not higher. If you own long-duration bonds, you're going to take mark-to-market losses. If you own cash, you're going to take real losses from inflation. The safe asset is no longer safe. What does work? Short-duration assets, treasury bills, floating-rate instruments, hard assets, things that hold value when currency loses value. I'm not giving you financial advice. I'm telling you what the mechanics dictate. Watch these indicators. 1. Treasury auction bid to cover ratios. If they drop below 2.2 for 10-year notes, that's stress. 2, the spread between 10-year Treasury yields and 3-month bill yields. If that spread inverts, meaning short-term rates are higher than long-term rates, that's a recessionary signal. But if it uninverts sharply, with the 10-year spiking above the 3-month by more than 200 basis points in a short period, that's an inflation and fiscal crisis signal. 3, money market fund flows. If you see large outflows from money market funds, that means institutional cash is moving, either into risk assets, which is bullish, or into alternative safe havens, which is bearish. 4, foreign treasury holdings reported by the Fed. If you see accelerating declines, that means foreign central banks are losing confidence. 5, the TGA, the Treasury General Account balance at the Fed. That's the government's checking account. If it drops below $50 billion and the debt ceiling hasn't been raised, the X date is imminent. Check these weekly. Don't obsess. Don't trade every move. Just stay informed. Know when the system is under stress. Know when to act. Zoom out. This isn't just about the debt ceiling. This is about the end of an era. For 80 years, the U.S. dollar has been the global reserve currency. U.S. treasuries have been the global safe asset. That status gave the U.S. an extraordinary privilege, the ability to borrow without limit in its own currency at artificially low rates because the entire world needed dollars and needed a place to park them. That privilege is eroding, not because of a single event, because of accumulated fiscal recklessness, because the U.S. ran deficits in good times and bad, because it fought 20-year wars on borrowed money, because it cut taxes and increased spending simultaneously, because it built entitlement programs it can't afford, because it allowed financial crises to be solved with debt instead of restructuring, and because every participant in the system, from politicians to central bankers to investors, chose short-term convenience over long-term sustainability. We're now at the point where the debt is so large and the interest burden is so high that the only solutions are unthinkable. Default, which destroys credibility. austerity, which destroys the social contract, or inflation, which destroys savings. One of those three will happen. The market is starting to price that in. March 2026 is when the pricing accelerates. The question is not if the U.S. fiscal position becomes unsustainable. It already is. The question is not if the market will eventually force a reckoning. It will. The question is, how long can the pretense be maintained? How long can the Treasury keep borrowing at rates that don't reflect the underlying risk? How long can institutional investors keep pretending that U.S. debt is risk-free when the fiscal math says it isn't? How long can foreign central banks keep holding an asset that's being systematically debased? And the answer is, not much longer. March is the stress test. And stress tests have a way of revealing what's been hidden. The cracks in the foundation, the leverage that was invisible, the assumptions that were never questioned. This isn't about predicting a crash on a specific day. It's about understanding that the system is fragile, that the margin for error is gone, and that when confidence breaks, it breaks fast. You've been told your entire life that U.S. Treasury bonds are the safest asset in the world, that the full faith and credit of the United States government means something. It does, but faith is a confidence game, and credit is a function of arithmetic. When the arithmetic stops working, faith evaporates. And we're in the window where the arithmetic stops working. That's what March 2026 is. It's not a political crisis. It's not a liquidity crisis. It's the moment when the market stops believing. The Treasury needs to refinance trillions in maturing debt. It needs to borrow trillions more to fund deficits. It needs to do this at rates it can afford. And it can't. The math doesn't close. The only question left is who pays? The bondholder, through default or restructuring, the taxpayer through higher taxes or lower services, or the saver through inflation. One of those three groups will bear the cost, and the Treasury has already made its choice. The path of least resistance is inflation. Slow at first, then faster. Because that's the only way to reduce the real value of the debt without technically defaulting. Your savings account won't survive it, because the interest rate it pays won't keep pace with the inflation rate the government needs to generate. You'll watch your balance stay the same while everything you need to buy becomes more expensive. That's not a prediction. It's a mathematical certainty. The only variable is timing, and the timing is now accelerating. March 2026 is not the end. It's the beginning of the unwind, the moment when the fiscal crisis becomes visible to everyone, when the Treasury market stops being a background abstraction and becomes a front-page catastrophe, when the language of debt, ceilings, and extraordinary measures becomes the language of survival. You can't stop it. You can't vote it away. You can only understand it and position yourself accordingly. The question is not if this matters to you. It does. The question is whether you're prepared for what comes next.